Hi students, welcome to the video on double entry system of bookkeeping. We focus on learn accounting, a complete course from beginners to advanced. So what are the glimpse of the topic? First, a brief description about what is bookkeeping, accountancy and accounting. So bookkeeping versus accounting. Then what are the bookkeeping process, importance of bookkeeping for the business, accounting process, then accounting cycles, transactions versus events, classification of accounting principle, what are the branches of accounting, double entry system of bookkeeping, that is accounting data versus accounting information, classification of accounts, what are the golden rules of accounts, that is traditional method and modern method of accounts. Then what are the 5 essential elements of any financial transaction or statements. Then basis of accounting, accounting equations, accounting terminology, that is basic terms, journalizing, steps for journalizing or how transaction travels, then ledger, subsidiary books and preparation of trial balance, and finally preparation of financial statement, that is income statement and positional statement. Imagine a boat without compass. You may not be able to know where the boat is going. Bookkeeping is just like a compass for the business. Without it, businessman cannot know whether the business is running at a profit or suffering from loss. Just like the boat, eventually the business will lose track of it and suffer financial losses. Then what is bookkeeping? Bookkeeping is the art of first identify transactions, recording transactions in the books of accounts, then classifying under various accounts, then accounting process includes then summarizing, analyzing, interpreting, and communicating to various users, maybe internal user and external users. So, first we should have a brief description about bookkeeping. So, bookkeeping is recording the business transactions of monetary aspects in the books of accounts. It is mainly concerned with record keeping or maintenance of books of accounts. It includes identifying, measuring, recording and classifying function of accounting. The bookkeeping function is routine and clerical in nature and can be performed by a person having limited knowledge of accounting. Then accounting is a wider concept. That means bookkeeping is a narrow concept and accounting is a wider concept. So accounting is considered as a system which collects and processes financial information of a business. Accounting starts where bookkeeping ends. It includes summarizing, analyzing, interpreting and communicating functions of accounting. This the most important accountancy, which is a very wider concept. It refers to a systematic knowledge of accounting concerned with the principles and techniques which are applied in accounting. So accounting is collection of theory and practices of accounting. Then we'll discuss what are the differences between bookkeeping and accounting. First, scope. So bookkeeping is a process of identifying financial transactions and events, measuring them in money, recording and classifying, that is transferring and posting them into the respective ledger accounts. But accounting, in addition to bookkeeping, is a process of summarizing the recorded transactions and events, interpreting them and communicating result to the various users, that is internal users of the business and external users of the business. Then second is stage. Bookkeeping is a primary stage, whereas accounting is a secondary stage. It begins where bookkeeping ends. Then objective. The objective of bookkeeping is to maintain systematic record of financial transactions and events, whereas the objective of accounting is to ascertain the net revenue or net result of operations and financial position and to communicate them or communicate the information to the various users of the business. Then nature of jobs. So bookkeeping begins being a routine function can be performed by less experienced staff. It does not require any specialized skill and knowledge. But accounting being a specialized function is performed by trained or experienced staff. Decision making. Data provided by bookkeeping is not sufficient for decision making. But in accounting, management can take important decisions based on the data obtained from accounting. Then level of skill. Bookkeeping is routine in nature and thus does not require any advanced level skills. But accounting requires advanced level skills and ability to analyze and interpret. Finally, who perform? So bookkeeping job is done by junior staff called bookkeeper, whereas accounting job is done by senior staff called accountants. So we can say accountancy is the body of theory and practice of accounting. Bookkeeping is a part of accounting and accounting is a part of accountancy. So bookkeeping is that branch of knowledge which helps how to keep a record of financial transactions. The need for recording financial transaction arises due to, first, it is difficult to remember the various financial payments received taking place during a period of time. In modern form of business organization, the control of business rests with persons and the results are to be reported to the owners. Third, the financial information required for the purpose of costing, budgeting, forecasting and planning also. So bookkeeping records are submitted to various government agencies like income tax, GST and other taxing authority for taxation purpose. Then we will discuss the bookkeeping process. So the process of bookkeeping contains the following steps. First, identification of the business transactions and events. First, identifying, then measuring those business transactions. All of you know what is transaction. Any exchange of goods and service either for cash or on credit is known as transactions. Then bookkeeping identify the transactions and measure those transactions in terms of money, record them in the books of account known as books of original entry or prime entry, that is journal. Then classify the transactions to various accounts, maybe personal account, real account, nominal account. Then accounting process starts where booking process ends. It includes summarizing financial transactions, then analyzing them, interpreting them, and communicating to the various users. So the process of bookkeeping contains the following steps: identifying the business transaction events first, measuring the identified transaction events second, then recording the business transaction journal or subjournal. All of you know what is subjournal. Subjournal means it is subsidiary books. As the transactions of any business is numerous, it is not advisable to record all those transactions in a systematic chronological order in the journal, and as a result it will be very difficult to know the financial information, that is whether a business is running at a profit or loss, then balance financial position. For the convenient purpose, journal is subdivided into various groups, that is known as subsidiary book. It is divided under 8 heads. First is cash book, then second purchase book, third sales book, fourth purchase return book or return outward book, then sales book, then sales return book or return inward book, bills received book and bills payable book. There are these are the 7 subsidiary book, and finally journal proper. Journal proper means if any of the transaction cannot be recorded in any of the above 7 subsidiary book, it will be recorded in the journal proper. So recording the business transaction journal, subjournal, posting in the ledger, balancing of ledger account, preparing the schedule of sundry debtor and sundry creditor, then preparation of trial balance. This is all about bookkeeping process. But accounting process, besides bookkeeping process, additional process or functions of accounting are first, analyzing the financial statement, interpreting the financial statement, communicating the interpreted data to the various users. Then you know what are the difference between accounting data and accounting information. Accounting data means it is in raw form, that is collection of raw data, that is facts and figures that are first collected then recorded. Whereas accounting information is the process and structured data that becomes meaningful for taking decision. Data lacks inherent meaning on its own because it is in raw form. It does not have its own utility or use, and it requires processing to become useful information. Accounting data, individual financial transactions like sale, purchases, payments, receipts, then source documents such as invoice, checks, bank statements, then raw numerical values from the general ledger or subsidiary ledgers before analysis. Accounting information, financial statement like income statement, balance sheet statement, cash flow statement, which summarize a company's financial health and performance. The reports such as accounts receivable, then aging, cash flow, forecasting, which promise consistency into specific area of business. Then we will discuss all the process, that is recording, classifying, summarizing, analyzing, interpreting and communicating. So recording, accounting is a process of identifying, that means beside bookkeeping, accounting considers the other, that is summarizing, analyzing, interpreting and communicating. So we will have a discussion from recording. So recording process, identify financial transaction events and record them in the appropriate books or a database. Recording is a basic phase of accounting known as bookkeeping. It is not possible for anyone to remember numerous transactions of his business. All financial transactions recorded in a systematic and chronological order in the books of original entry or prime entry, which is known as journal. So accounting records are the documents and books involved in preparing financial statements. So accounting records includes record of assets, liabilities, capital, ledger, journal and other supporting accounts and documents such as invoices and checks. Then second step is classifying. Process where transactions or entries of one or similar nature are grouped. The book containing classified information is called ledger. It is the principal book of account. It is also called books of final entry. It is the summarized record which contains all the accounts. Examples are transactions recorded in journal are posted to ledger. For example, asset account, liability account, capital account, revenue account and expenses accounts. These are the 5 essential elements of financial transaction. Then income, revenue account, revenue and expenses are 2 elements of income statement, and liability, asset and capital are the 3 elements of balance sheet statement. Then summarizing. Summarizing involves preparation and presentation of the classified data in a manner which is useful to various internal and external users. Internal users includes owners, board of directors, partners, officers, managers and other employees of the company who use financial information to confirm past results and help making adjustment for future activity. External users includes creditors, investors, agencies, internal standardized agencies, journalists, suppliers, government and customers. So accounting leads to the preparation of the following financial statement. First, trial balance, then profit loss account, then balance sheet, cash flow statement, statement of changes in equity. Then another step is that is analysis and interpretation. It includes analyzing and then interpreting the financial data to make a meaningful judgment of the profitability and financial portion of the business. The financial statement should explain not only what had happened, but also what had happened, but also what is likely to happen under specified condition. Then communicating means to share and exchange information, is concerned with the transmission of analyzed and interpreted information to the end user to enable them to make rational decisions. This includes preparation and distribution of accounting statement or annual reports. Then accounting cycle. Accounting cycle includes first journal, that is books of original entry. Subsidiary books are cash book, purchase book, sales book, purchase return book, sales return book, bills received book, bills payable book, journal proper. Then the transactions are posted from journal to ledger. From ledger it will be balance and we will prepare the trial balance. From the trial balance we will prepare one trading account, profit loss account and balance sheet. Then we will interpret those and communicate to the various users. Then here in the cash book we will record all received payment of cash. That is cash book. It is having suppose maximum 3 columns. One is this is left hand side is debit side, right hand side is credit side. One is cash column, another is the bank column, and third one is discount column. In the credit side also there are 3 columns, that is cash, bank, discount. This is triple column on cash book. Discount. In the cash we will write all receipts of cash. Then all payments of cash. Here in the bank column on debit side we will write cash deposited at a bank or check deposited at a bank. Cash or check deposited at bank. On the credit side of the bank column writes cash withdrawn from bank or check issued to various customers. Cash withdrawn or check issued. Then in the discount, this is cash discount, this is discount allowed, and credit side is discount received. So one is cash book. Then second one is purchase book. Purchase book records all credit purchase of goods or services. Mainly credit purchase of goods. Then purchase return records whatever the goods or business returned to the suppliers due to various reasons. It may be due to goods supplied by the supplier not according to our specification or not of standard quality, defective quality, damage in transit, whatever that may be, will return the goods to the supplier. That is known as purchase return or return outward. Similarly, whatever goods we sold to our customer, that will be recorded in the sales book on credit basis. If it is on cash, then it will be recorded in the cash book. Then similarly, our customer has every right to return the goods to us. That is known as sales return or return inward book. Then one bills receivable book, another bills payable book, then finally journal proper. So journal proper, transactions which cannot be passed in any of the above 7 books I discussed, subsidiary books I discussed, have to pass in the journal proper. The following transactions recorded in journal proper: first, opening entry. Opening entry means entries made at the time of commencement of business and also start of a new year for existing business or continuing business. Then closing entry for preparing final accounts at the end of the year. It includes various direct expense income transferred to trading account, indirect expense income transferred to profit and loss account. Then rectification entries, if there is any error after preparation of trial balance, some rectification entry will be done, that will be recorded in the journal proper. Then some adjustment entry will also be done, that is also journal proper. Then fine transfer entry, if any amount is transferred from one ledger account to another account, it is to be done through journal entry called transfer entry. Then miscellaneous entry. Miscellaneous entry include purchase, sale and return of fixed assets. Then that is credit transaction, writing off of losses due to bad debt, capital in kind. Then what are the abnormal losses? That all will be recorded in the journal proper. Then we will discuss the accounting principles. Accounting assumptions includes going concern concept. The business will run for a longer period of time. That is to be taken into consideration while starting a business. As a result, the asset will be depreciated, taking into account the life expectancy of the assets. Then consistency. The business should use a specified or the same accounting method over a period of time. Suppose the business is charging depreciation under straight line method, it should continue it till a longer period of time. And suppose it is following or it is applying reducing balance method, which is also accepted by the income tax departments or income tax authority, so it should be continued for a longer period of time. Then stable monetary unit, whatever may be the currency, it should be converted into Indian currency, that is rupee. Then accounting concepts are business entity concept. Business is treated separate from its owner. That's why the income and expenses business will be kept separate from income and expenses of the owner in order to arrive the actual net profit or net loss of his business and also the correct, true and fair view of financial position of the business. Then money measurement concept, whatever the importance of a case, if it cannot be measured in terms of money, it will not find its place in accounting. So only those transactions which can be measured in terms of money will be recorded in accounting. Then accounting period concept. Account period concept, that means accounting period includes 12 months. It may be one calendar year or it may be an accounting year. Calendar year includes, that is, it starts from 1st January ends on 31st December. The financial year, it starts from 1st April of one year, ends on 31st March of another year. So during a particular year of 12 months, whatever the profit or loss of the business, what is the financial position of the business, that is ascertained according to accounting period concept. Then cost concept, all the transactions or whatever the capital expenditure include on purchase of assets, it should be shown in the original value or book value. Whatever the market value, it is not taken into account. Then dual aspect concept. Every transaction is having a double side effect. If the one account, the transactions in one account affect the debit side, and the transaction it will of second account or another account will definitely affect the credit side of another account with the similar amount. As a result, both amount will tally. Then revenue realization concept, that means unless and until the revenue is realized, we will not take it into account. Then matching concept, the income and expenditure will be matched to ascertain the profitability of the business. Then accounting convention, disclosure, it reveals all relevant information. Then conservatism, reporting losses but not gains, that is conservatism. If there is any loss, possibility of any bad debt, we have to keep provision. Then suppose depreciation, we have to charge the depreciation. But if there is possibility of any profit, it is not taken into account. That's why we are following conservative principle of accounting, that is convention. Then materiality, it focusing on information significant enough to influence decision. Then objectivity. Objectivity convention or principle in accounting require that all financial transactions, a statement should be based on verifiable and objective evidence rather than any personal or biased opinion. Ensuring financial information is neutral, reliable, trustworthy for users like investors and creditors. Then we will discuss the transactions versus events. So transaction, any exchange of goods, services or money between two or more parties that alter the financial position of the business. What are the features of transaction? First, it involves an exchange of value between two parties. Then has a direct financial impact that can be measured in monetary terms. It has recorded in the company's accounting record. Examples are purchase inventory on credit, selling product to customer for cash, paying employee salary. Then events and happening or occurrence that affect the entity, which can be internal or external, financial, non-financial. Features may or may not involve an exchange of value, may have financial impact but not all events do. Then only events with a measurable financial impact are recorded in the business as transactions. Then financials are merger, acquisition, then sales, purchase. Non-financial are there is a fire in the go down, death of the company director, change in the market price. Then we will discuss the accounting terminology. In accounting, there are certain basic and accounting terms we should understand while recording in the books of account. These terms have specific meaning in accounting. Basic terms used are accounting terminologies or basic terms. Proprietor or owner, the person who takes initiative to start the business, invest his money or money's worth and bears the entire risk of the business is called proprietor. Capital refers to the amount invested by the proprietor in a business enterprise. It may be in cash or in kind. So capital is increased with the amount of profits and decreased with the amount of losses, and drawing and also withdrawal, that is drawing. Capital is also known as owner's equity or net worth or net asset. It can also be calculated by deducting the outside liability from the total assets. Then drawing. Any cash or value of goods withdrawn by the owner for personal use or any private payment made out of the business funds. Then business transactions. Any exchange of goods or service for cash or credit by the business with any other person is called business transaction. So transaction is an economic activity of the business that changes its financial position. Then events. An event is the result of a transaction. For example, Ram purchased goods worth 2 lakh and sold them for 2.50 lakhs. Thus, he earned a profit of 50,000. So transactions are economic activity of purchasing goods at 2 lakh, selling goods at 2 lakh 50,000. Event is the result of profit 50,000 earned due to the transaction taking place. This is the main difference between transaction and events. Then assets. Assets are the things of value. So assets are valuable resources owned by the business that are acquired as a measurable money cost. For example, land, building, plant, machinery, furniture, cash in hand, cash at bank, sundry debtor, bills receivable, investment, etc. Then debtor. Person or firm from whom amounts are due for goods sold or service rendered in respect of contractual obligation is called debtor. Debtors are collectively called sundry debtor. Total debtors are known as sundry debtor or total debtor. Total amount due from sundry debtor is known as book debts. Total amount due from sundry debtor is known as book debts. Then creditor. The person to whom amount is owed by an enterprise on account of goods purchased or service rendered or in respect of contractual obligation is called creditor. The creditors are collectively called sundry creditor or total creditor or trade creditor. Then bills receivable. An accounting term for bills of exchange drawn on debtor or received for way of endorsement from them. The amount specified in such a bill is receivable at a future date. These are reliable within a year or part of current assets. What is bills receivable? Suppose the business is selling goods on credit basis to the customer. Then, in order to have a certain certainty of payment, the business prepares a bill and sends the bill to the buyer or customer. Customer accepts the bills and within 2 parallel transfers line, he put his signature as accepted. Then he will send the bill to the buyer or seller. For seller it is bills receivable. For buyer it is bills payable. So bills payable, an accounting term for bills of exchange accepted in favor of creditor. The amount specified in such a bill is payable at a future date. These are payable within a year, part of current liabilities. Then accounting receivables includes both total debtors and bills receivable. And accounting payable also includes total creditor and bills payable. Goods. It implies all those articles which have been purchased by the enterprise for sale in the usual course of business. It also includes raw material purchase for further processing. For example, furniture purchase is good for furniture dealer, car purchase is good for car dealer, but furniture or car purchase of a cloth merchant or fan manufacturer are assets for them because these items are not meant for resale in the ordinary course of business. Then stock. Stock refers to the value of goods which are purchased for reselling and which are lying on store at the end of the accounting period. But inventory is a wider term which includes stock also. That means it includes inventory of raw material, work in progress or semi-finished goods, finished goods, inventory goods. It is applicable for manufacturing concern. Stock is applicable for trading concern. Then what is journal? All of you know when financial transactions are recorded in the books of accounts in a systematic and chronological order after identifying the transaction and measuring them in terms of money, the book of original entry is known as journal. Then what is journalizing? The process of entering, recording the transaction in journal is called journalizing. So what are the steps for journalizing or how transactions travels? So first is steps of journalizing. Steps of journalizing, of how journal transaction travels. First, source document required. Source documents. Source document means this is the proof of documents like invoice, bills, receipts, memos, debit voucher, credit vouchers. Then from source documents, transactions. What are monetary transactions? That will be, because transaction means economic, non-economic transaction, that is only monetary transaction is taken into account. Then after taking the transaction, we have to identify or ascertain two accounts. First we have to identify or ascertain what are the two accounts. Then classification of accounts. We will classify the account, whether it is personal account or real account or nominal account. That is classification of account. Then after classifying the account, we have to ascertain two effects. What are the two effects? Debit, credit. Ascertain the two effects. There is no specific definition of debit and credit. Debit to put on the left hand side of the account and credit to put on the right side of the account. All of you know account is in T for. This is account. Left hand side is DR, debit side abbreviation DR is written for debit side. Right hand side is credit side, that is abbreviation CR is written. Then ascertain two effects. After ascertaining accounts to be debited and accounts to be credited. Then accounts to be debited and accounts to be credited. So then journal is completed. Then in the specimen, there is specimen of journal, all of you know. First is date, then particulars, then details of invoice, then ledger folio, the page where it is written, then debit amount, credit amount. This is debit, then credit. It will be written side by side in the journal. Then we will have a discussion on GST. GST stands for Goods and Service Tax. Before 1st July 2017, every state had variety of taxes levied at different stages of trading. For example, previously separate taxes are excise duty, custom duty, VAT, entertainment tax, central sales tax, service tax, etc. All these taxes are included under GST in the year 2017. That is why GST is one nation, one tax, one market. GST Act came into effect on 1st July 2017, hold a great significance as both the central and state government rely on it, on the GST, for their indirect tax revenue. All of you know, should know, the GST do not include, that is, petroleum products are not included under GST. Petroleum products. Then liquors. These are not included under GST. It is according to the state government policy. Then GST, if the transaction is within the state, that is known as intrastate transaction, then two types of GST will be imposed. One is SGST, another is CGST. So the state goods and service tax, that is SGST, it replaces every kind of existing state tax, that includes sales tax, entertainment tax of the state, entry tax, etc. Under state government, state GST, good service tax, the state government can claim the earned revenue. Then central government's, that is CGST, the central goods and service tax. It is levied on transaction of goods and services which takes place within a state, imposed by the central government. Then If the transactions are between two states, that is known as interstate transaction, then IGST will impose, that is the integrated goods and service tax. It is applied on the interstate transaction of the goods and services. IGST is also applicable on the goods being that are imported to distribute among the respective states. Then what is accounting equation? Accounting equation signifies that assets of the business is always equal to its liability and capital. Most important is your accounting equation. Based on this, you have to prepare the financial statement, that is the balance sheet of a business. So first you should know what is accounting equation. Then after that, in the next video, we will have a discussion on various problems on accounting equation. So accounting equation states that at every time asset is equal to liabilities plus capital. All of you know that the claim of the outsider against the assets of the firm is known as liability. Claim of outsiders against the assets of the firm is known as liability. Then claim of owners against the assets of the firm is known as capital. So total claims against the business is known as assets. So asset, it means against the assets of business, two parties have interest. One is owner, that is claim of the owner is known as capital. Another is outsider, that is claim of outsider is known as liabilities. Then what is account? So I already discussed account is in T form. Account is in T form. This is account. Suppose it is X account. The left hand side is debit side, we will write DR, credit right side, we will write CR. All transactions relating to X will be recorded on debit side and credit side. Then, so account is a summarized record of transaction relating to a particular person, asset, liability, particular head of expense or income recorded in one place. This form looks like a letter T, so it is called T account. T account is a convenient form of analyze the accounts because it shows both the debit side and credit side of the account. Then classification of account. Account is classified under various sets. First is, that is accounts. Personal, real, nominal. Personal, impersonal. Impersonal is divided into two heads, that is real and nominal. That means it is divided under three heads. So personal account, real account, nominal account. Personal account maybe it is natural personal account or artificial personal account or representative personal account. Artificial or representative personal account. Three types. Then real, it relates to all assets. It may be tangible assets and intangible assets. Tangible, which can be seen and touched, like land and building, plant and machinery, furniture, picture, vehicles, investments. These are tangible. Then intangible assets which can neither be seen nor be touched, that is goodwill, patents, copyright, trademark, franchise, etc. Then nominal account relates to all expenses and losses, gains and income. Gains and income. Then you should know accounts of human beings are personal, natural personal account. Then artificial person means, so personal accounts, that is natural person, it relates to total personal account relates to individual, firm, company or an institution. If it is natural person, it is the list of human beings, accounts of human beings. Then artificial means it is the created under law. It do not have any physical existence but work as personal account. That is, it is created under law. That is, examples are farms, club, society, company, like etc. Then representative personal account. The representative personal account, it is a particular person or group of persons account. It includes all outstanding expenses, prepaid expenses, accrued income and income received in advance or unexpected income. Then we will discuss double entry system accounting. The system accounting transactions in the books of account on which both debit and credit aspects of each transaction recorded. Every business transaction has two accounts in opposite direction. It is necessary to debit one account, credit another account. So, double entry accounting system, suppose account A and account B are two first entry to the credit side. Suppose account A on the credit side and account B on the second entry on the debit side. When both sides tally, it depicts the accounting and record keeping accurate. So, we will now discuss some other points like basis of account. There are two bases of accounts. One is monetary basis of accounts. Then monetary, then accrual. Accrual accounting basis. So monetary means only on realization of cash or payment of cash only it will be taken into account, and it is considered a money basis followed by, that is money basis followed by professionals and small businessmen, very small businessmen. But most of the majority of the business follow the accrual basis. Under accrual basis of accounting, whatever the actual expense income relating to a particular accounting period, say 12 months, will be taken into account. For example, salary per month of the business 1 lakh, then for 12 months it should be 12 lakh, but business has paid only 11 lakhs. Under monetary measurement, monetary basis, then it will be 11 lakhs only. But under accrual system, it is 12 lakh. 11 lakh plus 1 lakh outstanding. That 1 lakh outstanding will be taken as liability in the balance sheet. Then another, suppose rent prepaid for 2 months rent period, suppose 14 lakh. Actually it's 12 lakh. So in money basis, it only 14 lakhs receipt will be recorded. But on accrual basis, 14 lakh minus prepaid 2 lakh, that is 12 lakh will be the rent paid. Similarly, any interest accrued, suppose the interest for 11 months is received, that is 11 lakh actual, it is considered in money basis. But it is, suppose it is money basis. Then on accrual basis, we will take 12 months interest, that is 12,000. 1,000 added and we will show in the balance sheet as asset. Then suppose rent paid in advance, prepaid. Total rent is suppose 14 lakhs. But you know rent per month is 1 lakh. So here 12 lakh will be taken into account. This is the difference between money basis and accrual basis of accounting. Then branches of accounting, there are 3 branches of accounting. There are various branches of accounting like financial accounting, cost accounting, management accounting, auditing, tax accounting. But for the basic knowledge, we will divide it under 3 heads, that is branches of accounting. One is financial accounting, that we are focusing. Then another is cost accounting, Then third one is management accounting. In financial accounting, our purpose is to get ascertain the net profit, net loss of the business and to know the true and financial position of the business. Under cost account, we have to ascertain the cost of a product, how it is arrived, cost of a product. It includes the preparation, that is estimation. First is direct material, then direct labor, then direct expenses, total is prime cost, then all factory overheads. All overheads will add. Overheads indirect expenses, that is factory overhead, office overhead, selling and distribution overhead will be added. Factory, office, selling and distribution will be added. Then we will get the cost of goods sold, then from cost of sales, then from cost of sales we add some net profit, we will arrive the sales. This is about cost accounting. The management accounting, it takes into account all the data to provide the management for taking valuable decision. Thank you for watching the video. In the next video, we will discuss the golden rules of accounting, modern rules of accounts, then we will prepare the journal, ledger and trial balance. Please don't forget to like the video and share the video to all of your friends so that everybody will be benefited. Please subscribe if not subscribed.